Good evening, everyone. I am Ivana Loroshinsky. I'm a certified financial planner and a financial advisor at People Wealth Matters. Thank you for joining us tonight. And being a financial advisor for 20 years, over 20 years at this point, and being the mother for over 30 years at this point, I would like to say that I made one of the best financial decisions in my life back in 90s when I came to the United States and got involved in a financial industry. And as soon as I learned about a 529 plan, I opened it for my daughter back then, who was a kid, and saved money for college that I used when she went to school 10 years later. And this fantastic plan helped me to help my daughter to get her higher education. Today, we have a presentation that will talk about the details on a 529 plan. And I would like to introduce to the participants Catherine Van Lanten, who is the assistant at People Wealth Matters. Catherine, say a few words.
Hi, everybody. I just wanted to let you know that you are all muted automatically. I know everybody always wants to know, oh, can you hear me? The background noise, but we have you muted. If you have any questions at all during the presentation, we have a Q&A section that you can go into or through the chat, and we will answer all questions after the presentation.
Thank you, Catherine. And the question is, there are 5529 plans out there. How do you make a decision? Which one is right for you? So to help you make a decision today, I decided to invite my good friend for many years. We go back many years in the financial industry. So I'm pleased to introduce the Senior Vice President and Consultant at Franklin Templeton, Kevin Golden. So with no further introduction, Kevin, take it away.
Great. Well, thank you, Ivana. I'm just pulling up my screen here, so just bear with me. Let me start. Ivana asked the question, there's 5529 plans. Why should you choose ours? Well, that's an important question. The bigger question is, if you are going to be at some point paying for education, child, grandchild, niece, nephew, anybody you love, the question is, what are you waiting for? That's the biggest question. What are you waiting for to start saving? That's the biggest question. I say to people all the time, they say, oh, which plan? Should I use your plan, another plan? I say, you know what, most importantly, you use any plan. As it's amazing how many people are not prepared, are not saving. That's the biggest question. I'm 24 years in the investment industry, and I think one of the biggest barriers to success for anything, whether you're saving for education, retirement, a home, anything, any aspiration, any long-term costs, whatever it might be, is really procrastination. It truly is. If you're working with Ivana, a great financial planner, someone who really cares about your well-being, the definition of a great financial planner is someone who is making all of your investments really around your goals, your short-term goals, your long-term goals. So it's not to knock down Ivana's question while she's absolutely right, which plan, why this plan, but really more than anything else, investing is all about goals. If I know I need a certain amount of money someday to pay for something, I should be asking the question, well, what can I do about it today? So I'll give you my real life example. And I'm very happy that I started not in the 90s, but 17 years ago. I have a daughter who's a senior in high school. I live here in New Jersey, Bergen County. She's a senior in high school. She is going through the college application process as we speak. Now, I'm well aware of what college costs in the year 2021, 2022, and going forward. However, I'm thrilled and extremely thankful that the day she had a Social Security number back in 2004, I started contributing to 529 plans. I have a younger daughter as well. I asked my parents to be generous as much as they could. I asked my in-laws. And now when I see what these costs are, and I know everybody in the line, I can't see your faces, I think we're all aware at the obscene cost of education today. And I say obscene simply because I think we'd all agree it's a very high number. Whether we agree with it, we don't agree with it, it doesn't matter. It's a big number, and it's going to be one of the largest purchases any of us make. So I'm thrilled that 17 years ago I started saving, and now as I'm looking at what the costs are going to be, the checks that we're going to have to start writing next August, September, we're going to be able to meet them and not have to take on more debt and not have to do other things financially that I don't want to do, start to dip into retirement funds and all of these other things. So I can tell you on a day-to-day basis, I see all of the different moves that people have to make, many of which they would rather not make to be able to pay these very high college bills. So that's what I want you to be thinking. If you're going to come away tonight with anything, I want you to call Ivana first thing tomorrow and say, Ivana, we have to start thinking about that college bill that's coming 10 years from now, 20 years from now, grandchildren that aren't even born yet that I'd love to contribute to. You really need to be thinking about it right away. There is urgency to doing this and to being able to achieve your goals. So I'm going to flip through a few slides here that I just want to use as illustrations as just to kind of drive home the point of why you need to invest for education. So that number that you see here on the screen, 410,855. If you were all live, I would ask you, hey, what do you think that number is? And many of you would probably guess, and you'd probably come up with it. That's the projected 4-year cost. If a child was born in 2020, what would the 4-year cost of education be for that child? Private college. Yes, we're using some high numbers, but if you look on the small print, what we're doing is incorporating in inflation figures of 3.58% for private, 3.72% for public. So we're not putting numbers on here that are not reasonable. 410,855. People say, oh, how can that be? I'll say it again. That's taking today's numbers, 2020, and just extrapolating out over the next 18 years at a I'm using the private number, 3.58% average annual inflation. 3.58 doesn't sound like a lot, right? We all talk about low inflation in the economy today, and it's not true. So that would be over $100,000 a year. Now, again, we all know that there's grants and scholarships and merit and other borrowing functions and all of that. This is just the hard costs. I think at the end of the day, we all want to know that we can pay for something, not have to borrow, not have to hope for other forms of help, which it's great if we can get it. But I'm just putting these numbers in front of you. And if you're a little scared, I'm happy that you are, if I could say that in the nicest of ways, because it means that you'll do something about it, okay? In financial planning, Ivana, did you want to say something?
I did want to interrupt you,
please,
Kevin.
Absolutely, go for it.
Because our housekeeper has a note for all of us here.
I can't see the screen. Can you make it in slide view so it's a little bit bigger?
Well, while you guys trying to figure this out, let me just make a comment here about my personal experience with the tuition. Also, the school that my daughter went to was Pace University, and the tuition was $40,000 a year. It's $45,000 a year now, and that is not counting room and board. So depending on the room and board, the living expenses, that's additional $10,000, $15,000, or $20,000. So an expensive school, but obviously there are different schools out there, less expensive, more expensive. And yes, the tuition cost, whether it's $100,000 or $400,000, the average American family has to come up with this money at some point. And 529 plan is the way to do it.
Number I was referring to, again, an immense cost. And like I said, this should urge you to act, okay? I don't mean to be, overly dramatic, but these are big numbers. And we all want to be prepared for these big costs as they come. And I think we all know the cost of education, while it's big, but it's valuable. You see on your screen here the different average earnings based on level of education. So I'm not here to tell you whether you should go to college or not. That's not the point of this conversation. But clearly, higher earners have various degrees, above high school. So I want to talk about putting time on your side. I talked a lot about acting now. So I think if you look here, this is an interesting scenario. These are three people that want to save for education or a future cost. Okay, so you take John, who was going to put away $250 a month for 15 years, Mary, who was going to put away $612 a month for 8 years, and Michael, $1,954 a month for 3 years. And you look here, and I'm wondering what everybody's thinking. Who's going to have the most money at the end? And interestingly here, what you see is the contributions are the highest for Michael, but the fact that he went the latest with the most money total was the person who started today. And I'll flip to this next screen, which will show it much more. It's really the power of investing today versus paying tomorrow. Okay. The sooner you do something, the real takeaway here is, even if you say, hey, I can only afford to do X, there's no such thing as only. You're better off doing something today than saying, oh, I don't have much I could put away right now, but maybe 10 years from now we will. The sooner you can do something, the better. So this is just an example we show here. Investing $439 monthly for 18 years grows to $186,000 if invested at a 7%. And I'll talk about the 7%, where that comes from, because this does get invested into various mutual funds, and I'll talk about that briefly in a couple of minutes here. But really, the key here is $439 monthly over 18 years is a total of $94,912. Okay, rather than, and again, we're looking at a public education college, so I saved $94,900 for $186,000 total cost. Okay, as opposed to paying tomorrow. If I was to borrow at a rate of 4.53 over 15 years, that's $1,420 a month that I would be paying. So what we're trying to say here is investing today, even if you do have to borrow years from now, you're going to have to borrow a lot less. And I hope, and again, I can't see you or hear you, so I wish I could see some nodding heads. I wish I could see someone who says they're confused or I don't get it. But again, I'll just give you my words. This is about putting something away now, every month, just chipping away, rather than what Ivana and I hear all the time, which is, well, right now we can't really find, something to put away. We all know we can do a little bit of budgeting. We all know that we can go out to dinner a little bit less, maybe eliminate one of the TV applications that we have, etc. And believe me, it adds up. But the real point here, like I said, is investing today will be significantly less than if you're paying tomorrow. So much of financial planning that Ivana specializes in is that whole point. As you get older, you want your debts to go down. You want your obligations not to start then. We don't want to be having to refinance and take on more debt. If we do, we do. That's fine. But the more we can do today, the less we'll have to do later on. So how do you invest in college? We clearly have already talked about the 529 plan being the way to invest, as Ivana really kicked it off and talked about 529s and which 529. Let me just step back for a second and just tell you again what a 529 plan is. Nothing wrong if you don't know that, if you say, oh, I've heard of it, but I'm not exactly sure. That is our jobs. Our jobs are to educate you, make you feel comfortable, make you really understand why we're doing what we're doing. 529 plans are state-sponsored tuition programs designed to provide tax incentives. Now, the tax incentives, and I'll show you more on another screen, are that you're putting after-tax money into these. So unlike an IRA, you're not getting a deduction off of your income. You're putting money you've already earned and paid taxes on, but the money grows tax-free. And when it is utilized for college, you're taking it out and you're paying no taxes on the gains. That money is all comes out tax-free. The entire idea of 529s, as Ivana talked about, she started using them in the 90s. The IRS created 529 plans so that you could have a way to save for education and do it in a tax-efficient way. There's many other investments, and I'll show you in a minute, that you can invest in. And yes, you can grow your money, but you're going to be paying taxes on gains in many cases. So I'll show you some examples of that. So what do 529 plans pay for? So all the money that would go into a 529 plan, when you start to take them out, you would utilize them for what we call qualified higher education expenses, which includes tuition, room and board, fees, books, required supplies, and equipment. I see people using 529 dollars for travel related to college. You know, that it's a wide range of reasonable costs. But think about how substantial, how many different expenses are associated with paying for college. So let's look at a couple of other savings vehicles that we hear often about in terms of saving money to pay for college. So 529, I'll say it again, earnings grow federally tax-free. The earnings that you make, when I say earnings, let's say you invested $10,000 in a 529 plan. It grew to $12,000. You are not paying taxes on that $2,000 gain that you would in many taxable investments. You also can take all that $12,000 out, no taxes, just use them for college. So the earnings grow tax-free, as I said, and well, I'll give you one other thing too, because you could see it on the screen. We talk a lot about college costs. $10,000 per year of a 529 plan can also be used for K through 12, private K through 12 as well. So I just mentioned that because you could see that on the screen. So I think that's something important also to know. Many of you might be sending your children, grandchildren to private kindergarten through 12th grade, and $10,000 a year can be used for 529 plans. Now,
that was, Kevin, I'm going to interrupt you for just a
please.
second.
Yeah, absolutely, anytime.
That was not the case years ago. They changed that, I guess, in 2017, right? That
Correct.
it could be used for private school, K through high school. So that's some change that could be attractive to some parents.
Correct. That was added in 2017. So let's just quickly compare to other types of accounts. Now, a UGMA, that's a Uniform Gifts Minors Act, UTMA. These are accounts that are set up for minors, okay? Traditionally, we've seen for years, a parent, a grandparent opens up some sort of savings account. Maybe they invest in a mutual fund, an individual stock. The kid loves Disney, so they buy 100 shares of Disney. And those are usually set up in what's called UGMA, Uniform Gifts Minors account. And all that is it's an account that is held until that child becomes an adult. Once that child is an adult, it is their money. They can take that money and do whatever they want for it. Nothing wrong with that. It'd be great if you're in a situation where you can open up some UGMA accounts as well. But understand, there is no stipulation that that money needs to be used for college. In a 529 plan, while you could take the money out, but you're going to be paying taxes on your gains as well as a penalty. So UGMA has always been for accounts that you say, hey, you know what? This is money. I'd like them to grow. If they could have this money, they can go do whatever they want. But the more and more families we talk to, because of the incredibly high cost of education, they want a lot of the savings to be, if it's an account that's in a child's name or the child's a beneficiary, they want the account to be in something that money is earmarked towards education. So the benefits, again, the 529 grows tax-free, comes out tax-free. UGMA, the money's not coming out tax-free, and it is not required. And I say required, meaning there isn't some sort of penalty attached to it if you were to not use it for college. Coverdales, if anybody knows the word, these have become somewhat obsolete. Coverdales were popular for years, as Ivana said, prior to 2017, because you could use a Coverdale account to pay for private K through 12. Coverdales are very limited in how much you can put in, so we are not seeing a lot of Coverdale accounts. 529s are just becoming more and more popular for many reasons, and I'll put a few more here. If you look at the maximum contribution, 305,000, so a very large number, and that's per account, meaning per beneficiary. There's many wealthy families that have multiple children that each have a 529 plan. And I'll tell you this also, there is no limit to how many 529 plans a child could be a beneficiary on. And when I say child, anybody can technically be a beneficiary on a 529 plan. You can be one, an adult. There's no age limit. But it's important when you think about a family. A grandparent might want to open up a 529, an aunt, an uncle, a parent, and one child can be a beneficiary on multiple accounts. Now, they probably wouldn't need multiple accounts of hundreds of thousands of dollars, but just understand that there's no limit to how many accounts they're going to be on, and I shouldn't even say hundreds of thousands. That's realistically more. It's going to be family members that want to just be generous and set up an account, and it could be a few $1,000s, whatever it might be. But that's per account size, so very high contribution rate as opposed to Coverdell accounts. No income limits, very important. So it's not, 529s are not capped to say, oh, if you earn above 250,000, you can't open a 529 plan. There's no limits whatsoever to that. There have been limits in the past to Coverdell accounts, no limits for UGMA accounts. And this is very important too. Let me just explain the ownership of a 529 plan. You know, as you contribute money into this, and we get this question all the time, just remember, you are the owner of the account. The child is simply a beneficiary, like any other accounts that you have, 401ks, insurance policies, etc. They're just a beneficiary. So they couldn't take the money and do whatever they want with it. You could change beneficiaries at any time. There's no limit. And you might do that in the sense of changing from one child to another. Maybe you used some of the money for a child and then you still had money left over. You could change a beneficiary, but you control the assets. And this is really important in so many different scenarios. They get this, asked all the time. Grandparents say, oh, you know what? I really want to save some money for my grandchild's education, but I only want them to use it for education. Well, you're okay. You're the owner. You control it. They can't do anything like that. Again, with the UGMA, UTMA accounts, which again can just be a basic savings account. You can go to a bank and open up a savings account and buy CDs. And when that child becomes the age of majority, it's their money. So I think the ownership standpoint of 529 plans is very attractive to many scenarios that we might hear from you. I mentioned the ability to change beneficiaries. It's a very big thing. There could be multiple people that benefit from this 529. It is a simple form that gets submitted, and the beneficiary, can be changed. Go ahead, Ivana, please.
If I may interrupt you, just from my experience. For example, there is a family that I work with. They have 3 children, and each child had a 529 plan. And one of the children decided not to pursue college degree. So the parents were able to change the beneficiary on that account that was designated for that particular child to those children that were pursuing the degree. It's very flexible. The child does not control the money. The parent, the owner of the account, or grandparent, for that matter, controls the money in this account. What I mean by that, if the child decides not to go to school, but maybe his or her child does, you can change the beneficiary to the grandchild. It's very flexible, and I've had multiple examples in my practice that no matter what the scenario, it always worked out. It's very easy, it's very flexible, and friendly to basically the owner of the account. The owner of the account makes all these decisions, where in a custodial account that Kevin talked about, UGMA, UTMA, those are custodial accounts where we name our child as the owner, and we act as a custodian up to a certain age. Legally, when the child reaches the age of majority, legally we are supposed to basically give the child the money, and there's nothing wrong with that, but there are taxes involved, there are other decisions involved there. So for higher education expenses or for private school, K through 12, the 529 plan makes much more sense than a custodial account.
Yeah. So I hope everybody just sees the flexibility with the 529 accounts. they're really becoming the most popular vehicle to save for education, for all the right reasons, for all the scenarios that we hear from people in terms of multiple children, multiple accounts, obviously the tax treatment, as we talked about, estate planning features for those that are doing estate planning as the assets are removed. So I think that's the takeaway that I hope you have, that as you're thinking about saving for education, the 529 plans are going to be the way to go. I'll just show you something unique about our plan too. Some of you know what crowdfunding is. I'll say it in a much simpler way. This is when you want to post on social media, hey, my daughter just turned 1, and you send it out to all friends and relatives and people that know you. Anybody wants to be generous and save for her college education someday, and you put a cute picture of your daughter. And you'd be amazed at how many generous gifts you can get. And some people say, oh, how's that possible? Well, think about every time you are raising money for something, some sort of cause or charity or unfortunate events that happen in different people's lives and hardships. And you'd be amazed at how much money comes in. Not a selfish thing to do. You're throwing a christening, a bat mitzvah, a birthday for a child, and you post on social media. And all people would have to do is click a link and literally would go to the crowdfunding site. They can make a contribution by credit card. I have heard incredible stories about fundraising efforts to help some hardship families, others that were just saying, hey, it's my daughter's 5th birthday, and we'd love, all people who love her to send in some money. So very cool. And that's something that when you set up an account is very simple to do. Lana can help you that out. It's all on our website and how you can simply click and post to whatever social media that you utilize to share and help raise some more money. So I'll just briefly go into quickly, talked about tax advantages. I'm just going to skip through a few things because I just want you to conclude really kind of knowing some important things. Here's a couple of 529 myths. I'm assuming most people on the line are from New Jersey. It doesn't matter if you're not from New York, Pennsylvania. It doesn't matter what state you're from. 529 plans can be used for colleges in any state. It does not matter. I'll get people to say, well, I don't want to buy Jersey's plan because my kid might be going to school in Florida. It doesn't matter. You can, in fact, use 529 money for about 300,000 accredited secondary schools around the world. It's global. It's amazing. You can go to savingforcollege.com is a popular site that I utilize a lot, and you can type in the most specific colleges, in Germany, and you'd be amazed at how many colleges accept 529 money. So it is absolutely untrue that you're buying the New Jersey plan. You can't use it elsewhere. Only parents can be an account owner for a 529 plan. Not true at all. Anybody can be an account owner for a 529 plan. So just know that as well. And there's a lot of different scenarios that you can talk to Ivana about where maybe you're a grandparent and you say, I'd rather put it in my child's name. All very, very easy things to do. What happens if, God forbid, I passed away? You always want to have contingent owners on a plan. Many grandparents put their child on there. So just know that too. It's not just a parent account. And I think this is important because, again, as I said, you see what college costs. Why not have as many people helping out as possible? Now, I'm going to just go again here, just a couple of benefits, and I'm going to, rather than asking because I don't have a live audience, but these are all key things also. There's no annual fee. Do you lose all the money if you don't use it for college? No, you don't lose all the money if you don't use it for college. Now, again, as we said, maybe you switch the beneficiary. Maybe you want to go back to school for something. You could become the beneficiary. If you needed to take the money out, you are going to pay taxes on the gains, and you're going to pay a 10% penalty as well on the gains. Okay, the money you contributed was already taxed, so there's a penalty. So you don't lose the money. Now, 529 vehicles, again, are for college savings. So it's not for someone who just wants to save money and grow it tax-free. There's other vehicles for that, but you don't lose all the money if you don't use it for college. Again, our plan is not limited to New Jersey residents. We have residents all over the country utilizing our plan. I will show you, though, that the largest amount of investors come from New Jersey because there are some benefits to our plan for New Jersey, and I'll show you that in a minute. We talked about no income restrictions. I talked about the maximum contributions. there's also very low contribution requirements. You could set this plan up for as little as $50 a month. Now, I'm all for you doing that, and I know I'd be a hypocrite if I said, oh, don't just do that. I did say, start early, start now. But I will say that, don't just put $50 in one time and think that we're magicians and we can turn $50 into $100,000, 10 years from now. No matter how good the stock market is, this is a vehicle that if you want to be successful in terms of having a nice amount of money saved, it's a really good ongoing contribution vehicle. Whatever you could start with, that's fine, but I would suggest trying to keep it going. One of the best advice I can ever give you in any investing is ignore all the news, ignore all the noise, ignore all the negativity that someone might say, oh, 529s are bad. I'm kidding. But people read something, hear something, and they start to say that. But there are very low contributions that you can start this up. You could use the plan, as I said, for all different types of schools. So this is not just your traditional 4-year liberal arts colleges. There's so many specialty schools we've been asked about over the years. Look them up, and most of them absolutely took $529. So very, very wide range of schools. What are we invested in? I'll just conclude here, and then just a couple of final points. 529 plans are invested in mutual funds run by Franklin Templeton. Mutual funds, most of you have heard of them. Mutual funds are pooled investment vehicles. There's stock funds, bond funds, there's balance funds that own stocks and bonds. Franklin Templeton is running these mutual funds. We have long track records on many of these strategies. Franklin Templeton started in the investment business in 1947. We've been around a very, very long time. And as I said, many of these individual investments have long track records. We started running the 529 plan for the state of New Jersey 18 years ago. That's when New Jersey hired us in 2003. So many of these portfolios, if you looked at them, you'll see inception dates as of the 2003 date, but many of the underlying investments have been around a long time. And won't go into this in detail, mainly because this is a conversation you probably would have directly with Ivana, who would recommend where to go. There are investments called age-based allocations, which are invested based on the beneficiary's age. In other words, as you get closer to college time, you might want to be a little more conservative, because you and I know if you're 16 and you're going to be using the money in 2 years from now, you don't want to take on added risk that maybe the stock market has a bad year the year that you're going to college. So they tend to get a little more conservative as you get closer to college age. We have portfolios that you can choose that are just a mix of funds. And again, don't be concerned by this. Don't be confused by this. This is a conversation to have with Ivana, who is your financial advisor, financial planner, and would decide what's best for you. You have the ability also to choose individual funds. I'll say this about advice. It's very important that I know many of you on the line here are already working with Ivana. Some that aren't, please do. She's not asking me to do a commercial for her, but I absolutely will. We are at a time in this world where investors have never needed advice more than they need it today. Why? Life's complicated. Life's expensive. There's a million opinions on everything. What does a good financial advisor do? They have your best interests. They care about you. They want to help you achieve your goals. My personal role is to work with financial advisors. And I know Ivana is there to help you achieve your goals, cares sincerely about you, and is practicing the same thing. I love how she kicked off today's event, in terms of doing this for her own child. So please get advice. And if you have friends, loved ones, people you care about at all that are not getting advice, it is a great idea to recommend they talk to Ivana. She did not ask me to do a commercial, but I'm more than happy to do just a quick one. So let me just step out 1 second here, and I want to just show, because I get that question, and Ivana said it earlier in terms of, why would you buy the Franklin 529 plan? And there's a number of reasons, but I will highlight one here. It's taking my screen a second, I think, to. Okay, so you can see special benefits exclusive for New Jersey families. So I told you about Franklin Templeton. I think people know us, Ben Franklin logo. We are a name firm. We manage globally $1.6 trillion, not just in 529 plans. That's in in retail client assets, institutional assets globally. I mean, we have a presence in over 100 countries worldwide where we're managing money. So we have the reputation. We're a highly rated company, publicly traded company. But specifically, I'll get questions from investors and they say, oh, I heard about this plan from this state, or I heard about this plan from this company. As I said earlier, I promise you, I want you to invest in 529s, number one. And if you didn't choose Franklin Templeton, at least you did something. That's very important. But for those of you that live in New Jersey specifically, there are specific benefits. And that's true of many states' plans. There's a lot of states in this country that I would tell the person, if you live in that state, you should buy that plan because the state is giving you some specific benefits. So here, New Jersey is offering, and this is beginning in tax year 2022. So it wouldn't be for the current filing, but starting in January, your contributions will offer you a state tax deduction. Now there is a ceiling on income. So if you see this here, see if I can make this a little bigger. That should help. There's a state tax deduction up to $10,000 per taxpayer per year with a gross income of $200,000 or less. So simply put, your income, if it's less than $200,000 and you contribute, let's say you put the full $10,000 in, you would deduct $10,000 off your state income tax return. That's just using a $600 or a $700. That's a $600, $700, just simple math savings for you, for the year. So, New Jersey's doing this to incentivize you to say, hey, invest for college. College is expensive. We would like to limit how much we have to loan you in time, and we want to get you going on this. So that's a nice offer. A lot of states don't offer state tax deductions. Some do. New York does. Pennsylvania does. But very important for you to remember. If you want a state tax deduction, you need to invest in the Franklin, New Jersey plan. You could not buy the New York State plan. I'm just giving you neighboring states, Pennsylvania plan, and get a state tax deduction from New Jersey. You can here. Matching grant program. So for earners, for people who earn less than $75,000, this plan offers a one-time grant up to $750 matched dollar for dollar on your initial deposit. So if you put $750 into your initial account, you're getting $750 matched from the New Jersey College Affordability Act. So that's free money. That's great. So I would highly recommend at least putting that number in. Go ahead, Ivana.
Kevin, we do have a question for you, and maybe Kate, maybe you could read that question about the taxes.
Yeah, is that, you'd said that it was 10,000 deduction, and it said per taxpayer. Does that mean that a married couple filing jointly gets 20,000, or is it still?
No, so a married couple filing jointly would be considered one taxpayer, but a married couple who file separately would be two taxpayers.
In other words, this needs to be also confirmed with the accountant that is helping you file your taxes. But if you are if you're married and filing jointly, then the answer is no. If you are filing separately, then it depends on the income levels.
Correct.
You're reporting.
Exactly. Said it. Yeah, exactly. Exactly. But a joint filing would be considered one taxpayer. Does that make sense?
Yes.
Okay. And number 3 here, scholarship opportunity. We offer up to a $3,000 scholarship for the beneficiary if they attend a New Jersey school. Now, understand, we're not trying to, push a beneficiary to go to a New Jersey school. It has nothing to do with it. The state is simply saying that if you went to a New Jersey school, you can get up to a $3,000 scholarship. It's a very easy filing that you do from our website. And the first semester of freshman year, they would get $3,600. You could see here it is prorated though, so they would have to have contributed $3,600, which most people would have by then, and have the account open for 12 years. So again, the cynical person might say to me, well, my kid's probably not going to school in New Jersey. Well, so what? What if they do? All right. I'm sorry if I'm taking that tack with people here, but it's some of the things I hear from people who say, oh, no, I'm not going to buy this plan. My kid's not going to New Jersey school. Well, so what? They're giving you money even if they did. And we never know, I mean, that's silly to think that way. So again, enough reason certainly to say, if I'm going to open a 529 plan, I might as well go with the state's plan. They're offering me something. If I buy another state's plan, they're not offering me anything. And I will say also, and we've done a lot of studies on this, there is nothing in most states' constitution that doesn't say that they couldn't tax out-of-state 529 money on its gains. So again, I know most of you aren't thinking about this right now, but I have had people say to me, well, I invest in, XYZ company's Virginia plan. There is nothing that says in there that they can't collect taxes on the gains in their plan from out-of-state residents. There has been some precedent on other types of investment products where they, state budgets, are always sometimes looking for more money, and it's a way to get. So again, I'm just trying to tell you, and I know I'm going deeper than I need to. If you're going to go 529, go the New Jersey plan. There's no interference with New Jersey financial aid. And remember, New Jersey financial aid can also be for out-of-state schools. So understand that. So in other words, they're not going to look at your 529 assets when you are applying for financial aid. And there's full credit protection too. This is something under New Jersey plan law, plan assets are exempt from claims of creditors and excluded from an estate in bankruptcy. So again, none of us ever want to be sued for anything, and we all hope we never will. You just never know in life. And the last thing you need is someone to be suing you and trying to get the $50,000 that you saved for your child's education. Very important, credit protection. You don't have credit protection if you're buying an out-of-state plan. So these are 5, I think, pretty good incentives. So I'll conclude there, and I'll just again say to you, the most important thing here is that if you believe you're going to be at some point contributing to the cost of education for a child, a grandchild, anybody that you care about, this should be part of your financial plan. 529 plans are very easy to set up. They're very easy to invest in over time. These are going to be your, and I hope, those of you have a 401k, a 403b, IRA, these are going to be those accounts that I know Ivana well enough. She's going to say, don't worry about that. Don't look at that on a daily basis. Don't look at it on a monthly basis. I will make sure that they're doing what they need to do. But I'm telling you, that's incredible advice, because you wake up 15, 18, 20 years later, like Ivana talked about, like I'm telling you right now, and you say, wow, I'm going to be able to meet this cost. So I wish you all the best. And, the time to start investing in this was yesterday. So what questions do I have from everybody who's out there?
Kevin, the most recent question was about the grant. Oksana asked if it's just for new accounts, that $750 bonus.
For grants.
The $750 grant, it was.
Yes.
Is that only for new accounts?
Those are for new accounts. Okay. I'm sorry. I thought you were asking me about grants, but those are for new accounts.
Let me clarify here. When you say new accounts, is it a new account with Franklin Templeton? Like, for example, if I have an account elsewhere, it's a 529 plan, let's say, I don't know, Virginia for that matter, and I would like to transfer that account because 529 plan could be transferred from one plan to another. And let's say I, as a New Jersey resident, decide to do that. How does that work? Can I transfer? What are the tax implications? And do I get that grant because I'm now a new account holder at Franklin Templeton?
Yes. So a couple things. Let me actually get back to you on, would you get the grant money? This grant was recently added, and I will get back to, I'll get an answer for you tonight probably, just in terms of, do you get that $750? But to the rest of your question, it is very easy to transfer in an account. It's a qualified transfer, meaning there is no tax ramifications whatsoever. You are simply moving from one 529 plan to another. The assets wouldn't be touched. There's no penalties. There's no costs. You could actually do it at what's called net asset value, which is no sales charge at all to get in. So, and I highly recommend it because that money will now be in a plan that going forward, you could take advantage of potentially the tax deductions, the scholarship, et cetera. The grant, the $750 grant, let me check on that. it might require that you add the 750 to it because it is a new account. So you get what I'm saying? So you moved in $25,000. It might not trigger the 750. You would maybe need to put the 750 in because it is a new account. But I'll clarify that for you.
That'd be great, Kevin. And
Sure.
thank you very much for your commercial, even though the 529 plan that I own is not Franklin Templeton. Back then, it was not available.
I know. I knew that. I knew that. Yeah.
However, it was actually a Rhode Island plan,
Sure.
which was used in New York for the resident of New Jersey. So
Yeah.
it's not like we have to purchase the plan with Franklin Templeton only because we live in New Jersey. There are many other things to consider, like investment options and the performance and all these details. But this is a very individual decision. In other words, the clients, particularly those who do live in New Jersey, should look into Franklin Templeton 529 plan. And the reason being, obviously, it's impossible to predict where your kid is going to go to school, but if it is Princeton University, you will be able to use those incentives that Franklin Templeton will give to the account holder for New Jersey resident and for the kid being in a New Jersey school. So that's just my 5 cents that I wanted to put out.
And
there.
just to clarify, just because what you said, what really matters is where do you live, the account owner? That's the most important part. So it's yes, there's some, you get a scholarship, you know, if the beneficiary goes through it, but it's about the owner. If you live in New York, Ivana's right. That's an individual situation. You might get a tax deduction from New York. But if you live in New Jersey, this is the best plan for you, most likely.
Kevin, that brings me to her follow-up question. She was just asking, does Ivana said there are 50 529 plans.
50, yeah.
Yeah. Does Franklin Templeton manage any other states, or is it just New Jersey?
We don't. We manage just New Jersey.
Typically, that's the case. The company, the management company, the investment company is managing one plan. Typically, that is the case. I've been working with Franklin Templeton as the company, as the investment company, again, since I've been in this business, which is over 20 years. There are multiple incredible choices that are available through Franklin Templeton. So that could be an individual discussion with anyone who could be interested in exploring the plan further. But, you know, company-wise, Franklin Templeton is it's the name that is well known, and it's the brand, and it's also, you know, tons of money. 1.6 trillion, you said, Kevin. Franklin Templeton manages the pension plans, 529, and individual investors, institutional investors. So good name, incredible investment choices that are available through the plan. I like it. I personally like it very, very much.
The first question we had, which Kevin, you did answer, but maybe you could just reiterate, what happens with the money if there's still money left after all college expenses?
May I answer this question?
Yeah, go ahead, please. Absolutely.
I still have the money. My daughter is done with college many years ago, and luckily she did it in 3 years. So she saved us quite a bit of money. And the leftover, surprise, surprise, the leftover that is in a 529 plan still is earning, it's invested. It is invested, it's performing, and the money is there. And I can, as the owner, I can take this money out anytime I want. I will have to consider what are the tax implications of that withdrawal, but it's available to me. I can take it out. The other thing that I can do, I can change the ownership on that 529 plan from being myself to being my daughter.
The beneficiary, you mean?
Pardon?
The beneficiary?
She is the beneficiary, but you can also be the owner. In other words, she can be the owner and the beneficiary of the account, or I can make myself the beneficiary on that 529 plan and use this money if I decide to pursue some degree for myself. And I would do that or the other if we intend to use this money for higher education, or if I am lucky to have a grandchild someday, maybe I will name a grandchild as the beneficiary, or my daughter, as the owner of the account, names her child as the beneficiary of that account. So it's very flexible. It's available. The first thing that we can do, we can take a withdrawal. I can take a withdrawal. I don't want to do this. I don't want to pay taxes. The money is growing there. So changing the beneficiary could be one of the things to consider. Changing the owner of the account. And if the goal for this money to be used for higher education expenses or for private school, it's very flexible. It's up to me or up to the owner of the account. If I decide to name my daughter, to transfer the ownership of the account to my daughter, she makes the decision what to do with this money. And if she decides to take it out, she can, but she will have to deal with the tax consequences. And it all depends on her tax situation, on my tax situation. But it is very flexible, very easy, and it depends on your personal financial situation, what to do with the money that is left over. If you're lucky to have some money left in a 529 plan after your kid graduates.
And I think that, Kevin, you did talk about this. If you move to another state down the road, like Ivana was just saying, the flexibility. What do you do if you move to another state?
Again, I want this to be, very clear. It does not matter where you live. It does not matter where you go to college. You can own anybody's 529 plan. It has nothing to do with, as I said, anybody can buy the Franklin, New Jersey 529 plan. What you're getting, though, by being a New Jersey resident is those benefits. If you moved out of state, well, then you wouldn't be getting, and if you're not paying income tax to the state of New Jersey, so you might be giving up the tax incentive. But the assets never matter. You could be living on, in Europe, you still have a 529 plan. It doesn't matter. So I'm just being adamant about it because I don't want people to get confused at all, to worry about, well, I might be moving to this state, that state. That's why I started off this presentation tonight, that it's really about investing in a 529 plan. And hey, by the way, Franklin's a great plan and a great company. And if you live in New Jersey, we're the best plan for you. But you can buy, 529 is simply a word that the IRS created. It's section 529 that the IRS created in the 90s. So does that answer you, Kate? It does not matter where you move. That's not going to affect the assets at all. My parents live in Florida. They have a 529 account for my children.
Think about a 401k. When you leave your employer, you move. It doesn't matter where you live, but it's still your money. It's still your account. It's still under your name. What you do with that account, you can leave it there. You can move it somewhere, but it's your money. It's under your name. Same is true about 529 plan. It's not like you are tied to New Jersey. However, if it works out that you are still in New Jersey, you can get additional benefits, because the tax deferral of a 529 plan, it applies no matter where you live. The tax deferral of that growth, of that investment, applies to any 529 plan. So it doesn't matter where you live. It doesn't matter, you move, it doesn't matter. However, if it happens so that you end up living in New Jersey at the time that your child goes to get the degree, higher education, there will be additional benefits to that 529 plan for New Jersey residents has. But I would not be too tied to this particular feature. right now, because the main thing is to start somewhere. And if you are thinking which way to go, if you live in New Jersey, it's easy to make a decision, because that is the plan that is available here with all these incentives. And if you don't, like I said, you can compare this plan with what you have in your state, but you do not need to be tied to New Jersey state. If you move somewhere, your money moves with you. It's still under your name, and it still benefits your child, your beneficiary.
Yeah, my best advice is don't get caught up on the state. It really isn't. Put money in a 529 plan if you want to save for education. It's that simple. And we're one of the best providers.
And
The stuff on the state stuff is just added incentives. That's all they are. The best advice I usually give people is that buy your own state's plan. It's probably the best way to go. But like Ivana said, the tax-free growth, the tax-free withdrawals, all the flexibility, it applies to anywhere you're living. It'll always apply. None of that matters. The key is to start investing now.
That's the next question, Kevin, is that can a 529 be open for a child who lives in another country?
Yes, a beneficiary can live anywhere.
Do we have any other questions coming in, Kate?
Let's see, it looks like that is it.
Well, I think that we covered a lot today in this presentation. Again, Kevin, thank you very much for doing this for us tonight. And I would like to also thank the Ukrainian American Business Association for providing their Zoom platform for us to have this presentation available to the members of the UABPA as well. And I thank everyone who joined. I thank Catherine for doing such a nice thing, being our housekeeping host here. And I encourage all of the attendees to reach out if you have additional questions or clarification. Don't hesitate to bring up whatever your concerns might be. And if you do own a 529 plan already, contribute into it, review what it's doing for you, and if you have questions, again, reach out. We'll be happy to help. We will have a recording of this webinar available at some point, so maybe you have some friends or family members that would be interested in what we talked about today. But I would like to conclude with saying thank you again to all the participants for sharing your evening with us tonight, and to you, Kevin, for your wonderful presentation.
Great. Thank you, everybody.
Thanks.
Good
Kevin.
night.
Good night.
Have a great night.
You too.